Welcome back to the Neuro Finance Masterclass. Today, on day 120, we master the ultimate truth detector of price velocity. I'm your host, Ibrahim.
And I'm Emre, your co-host. Look, if you've been with us on this 365 days to financial freedom journey, you know we're deep into phase 2 right now. We're finally moving way beyond the surface stuff and really looking under the hood of these financial markets. So get ready, because today's explainer is going to completely change how you look at a chart.
All right, let's jump right into section 1. The facade of price. So yesterday on day 119, we laid down the structural framework using moving averages, right? Well, today, we're stepping into the sensory engine itself, because what we actually see on the surface, the price, is honestly a pretty misleading facade.
Exactly. Amateurs get so caught up in that facade. They spot this giant, shiny green price candle surging upward, and they just assume, oh wow, the trend is incredibly strong, and they just trade on pure FOMO.
But architects, we operate totally differently. We know price is literally just a fresh coat of paint on a car. What actually matters is the internal momentum, gasoline, that's powering the asset. Like, is the tank actually full, or are we just running on fumes here? Which brings us to section 2, the RSI momentum engine. So you're probably wondering, what's the actual tool an architect uses to measure that internal fuel? Well, it's the Relative Strength Index, or RSI, created by J. Wells Wilder.
At its absolute core, the RSI is a momentum oscillator. Think of it like it's tracking a massive, continuous tug-of-war. It calculates the ratio of recent average gains, so the buyers pulling forward, against the recent average losses, which are the sellers pulling backward. And it plots this entire battle on a super clean scale from 0 to 100, showing us exactly who's actually winning the fight inside that price.
Now, the million-dollar question. What time period do we actually use to calculate this average?
The answer is 14. Period. Universally. Institutions, massive trading algorithms, seasoned architects globally, everyone has basically standardized the RSI to a 14-period lookback. By setting it to 14, you're literally plugging yourself straight into the collective heartbeat of the market's standard operating rhythm.
And this RSI gives us two totally critical boundaries to watch, 70 and 30. When it pushes up above 70, the asset hits the overbought zone. That means the upward velocity is stretched way too thin, the buying engine is running super hot, and the market is hitting total exhaustion. Conversely, when that RSI drops below 30, it's oversold. The downward liquidation pressure is completely overextended itself. Sellers have emptied their clips entirely. What that does is create this highly coiled spring, primed for a really violent reversal back to the upside. All right, let's move on to section 3, regular divergence and spotting reversal anomalies. Okay, here's a massive secrets of the Neuro Finance Masterclass. Pay attention to this. True mastery doesn't come from just blindly staring at those 30 or 70 lines. No way. It comes from hunting structural anomalies. We're talking about the elite science of divergence, or Uyumsuzluklar in Turkish. Clinically speaking, divergence is that precise, beautiful moment when the price action mathematically decouples from the momentum velocity. The facade on the outside is screaming, "We are rising," but the internal engine is whispering, "We are completely out of gas." And there are two main ways this decoupling plays out. First, you have regular bearish divergence. This is when the price pushes up to make a higher high, but the RSI totally fails and prints a lower high.
Right, and the exact opposite of that is regular bullish divergence. That's when the price drops to a lower low, but your RSI shows this hidden strength by actually printing a higher low.
You absolutely need to engrave regular bearish divergence into your brain. Picture this, you're right in the middle of a euphoric bull run. The price looks incredibly shiny, printing a fresh new higher high. All the amateurs are popping champagne and celebrating. But look underneath. The RSI is quietly printing a lower high. That buying velocity inside the order book, it's severely decaying. The buyers are completely running out of breath. That shiny price is literally masking a dying engine. When you spot this anomaly, you've got to recognize it as a blaring warning siren that a violent collapse is right around the corner. Now, let's completely flip the script. Regular bullish divergence, that is your signal for immense opportunity. We're talking about absolute bear market capitulation here. The price sets a terrifying lower low, and there is just incredibly loud panic all over social media.
But check the RSI. It's printing a higher low. The ledger is showing actual selling exhaustion. The sellers are just done. So while the retail crowd is blindly panic selling at the absolute bottom, the architect uses this exact signal to see that smart money is quietly absorbing the floor. And that is exactly where you step in.
Moving right along to section 4, hidden divergence, or trend fuel. So,
While regular divergence is great for spotting major market tops and bottoms, we really need another tool for when a trend is already chugging along. Enter Gizli Uyumsuzluk, hidden divergence.
Spot on. Hidden divergence is literally the architect's ultimate insurance check. You should never, ever blindly enter a major trend continuation setup without running this exact audit. It tells you if the trend actually has enough structural fuel left to keep going, or if you're just buying straight into a trap.
Let's break down the clinical mechanics of hidden bullish divergence. It happens during an already established uptrend. The price pulls back, right? But it maintains its overall structure by printing a higher low.
Yeah.
However, your RSI drops all the way down, printing a lower low. Just think about what this actually means. The momentum engine has completely reset itself to the downside, but the price barely even budged. And when the RSI drops that far without breaking the price floor, it just violently flushes out all the weak hands in the market. The momentum engine gets completely reset, it's primed with fresh fuel, and yet that structural price floor remains totally intact.
Emre, for an architect, this is the absolute ultimate green light. This is the precise moment you deploy heavyweight using the DCA engine we talked about back on day 69. It's just maximum efficiency.
All right, finally, Section 5, the architect's momentum audit. Okay, we've covered the theory, we've gone through the psychology, now it's time for your day 120 cognitive task, the momentum audit.
Here's what you're going to do. Open up TradingView, pick your core crypto asset or your absolute favorite stock chart, and apply the standard 14-day RSI on the daily time frame. Your mission?
Scan the last 2 macro cycles.
I want you to locate one regular bearish divergence that served as a massive pre-crash warning and one hidden bullish divergence that perfectly set up a continuation run. Go map those cracks in the momentum for yourself.
So I'm going to leave you with this final thought for today's explainer. Amateurs trade the facade. Architects trade the velocity. And the tools, well, they're in your hands now. Are you ready to stop acting like an amateur? Audit the true velocity of the market, and finally rule the cycle? Seriously, go run your momentum audit today.
We'll see you back here tomorrow for day 121 as we keep building your path to ultimate financial freedom. Stay focused, stay disciplined, and keep building.